Welcome back. Episode 13 of Making Sense of Your Money. As you can already tell, Elizabeth is back. So, I know that I've been speaking to a lot of clients that Elizabeth's been the point person. As you know, she is back. We did think that the market was going to correct itself when Elizabeth came back, but they must not know yet, Elizabeth.
I know. We thought Baby Weston was going to be like the lucky charm here for the market, but apparently the market didn't get the memo. But the baby's great, so that's all that counts. So yeah, I figured, what better topic than to just kind of dive right in as to what's happened over the last couple months. While I've been kind of away with the baby, and kind of where we're at right now in the market. And then, Jeff and I are going to maybe talk about some opportunities I think that are out there right now for different clients depending on where they're at. So I think one of the first things that we really need to kind of dive in and take a look at is what's actually going on out there, right? So in the traditional sense, when it comes to investments, right, we've got stocks and bonds, and stocks, as we know, right, they go up and down. Bonds have always just kind of been like hanging out over all these years. They don't really have a whole lot of moving and shaking. However, times have changed, and that's kind of where we're at now, which is we've seen changes in interest rates finally, right? We've been, Jeff and I, probably talking for 5+ years of at some point they have to come off the floor, and when they do, it's going to be a problem for bonds. Well, here we are. This is where we are in 2022. So when you go to like your normal, your typical 401ks, your 403bs, that's your mix of tricks is stocks and bonds. So there's not a whole lot of safety for those investors right now. And when you look at the market today, you have major indexes such as the S&P. As of May 26th is down almost 15%. The Nasdaq's down over 25%. Your bond index, once again, this flight to safety that most people have is hurting this year too. It's down 8.5% as of today. So the old adage of I'm going to have a certain percentage of my money in stocks and a certain percentage in bonds, and it's going to slowly get more conservative over time, is burning a lot of people right now. So we're going to look at just a quick chart to kind of show you as of today what those different types of allocations look like. So what you're going to see here is a lot of numbers, right? But on the left, it shows us those different types of portfolios. So for instance, that first line, 100/0, is looking at a portfolio that's 100% allocated to stocks, 0% bonds. And you can see, basically the weighting slowly gets more and more heavier towards the bonds and less towards the stocks. In normal years, when the market's down, you're going to see like 2018, for instance, we had, yes, some negative impact on especially those stock heavy portfolios, but the lower down the chart you got, you could have potentially been flat or relatively flat, depending on what your allocation was. This year, however, it's all in the red, right? And that's the scary part, I think, for a lot of investors. So we've got, that 100/0 portfolio is off, 17+% potentially this year. And you've got even your most conservative, someone who's really in just, I'm going to put it all in bonds, I'm going to stick away with stocks, could potentially be down over 8% right now. So I think this gives, kind of validation to how Jeff and I work with clients, how we build portfolios in two senses. We look at things such as bucketing money, right? Making sure that the money that we have in the short term is not invested the same as how it's going to be in years 8 through 15 and 15 years plus. And in those buckets, even including the short term, we're not just throwing it all in bonds because bonds are quote unquote more conservative. We're using tactical management, which has really been a leader in what's going on in the market right now in helping clients have potentially a lot less volatility in those accounts. And they're not seeing those drastic downsides for that money that they're spending on those first 7 years, like they would if that money was just staying in potentially a 0-100 portfolio in their 401k.
And just to kind of add on to that too, just a little bit more is, with the tactical management, the like Elizabeth said, the thought is, well, the flight to safety is let's fly to bonds. Well, as you saw in this chart, bonds aren't having a great year. So now these tactical managers are able to say, okay, we're going to fly to cash and we're going to wait for a better opportunity that we see. Hey, once things stabilize, we're able to get back into the market when we feel like it's time in different sectors. So I just wanted to make sure I added that. I don't know why I'm flying all over the place today, but we're flying to cash.
I think it's great. Do you want to touch, maybe Jeff, do you want to maybe like piggyback on that opportunities and talk a little bit about maybe some of those opportunities for our younger clients, and then I can kind of circle back and talk about maybe some of the things for those in the retirement zone.
Sure. And, we've certainly talked to a lot of different people around this, this time of the market, right? This is the time where Elizabeth and I are generally the most busy with incoming calls. This is why people have us. And so a few things, now when you see this volatility in the market, if you're adding systematically or adding, biweekly, monthly, things like that, I like to tell my clients, I want you to think about when your money leaves your bank account and goes and gets invested, you hope that the market is down that day, because the same investment that we thought was good 6 months ago, 7 months ago, it's not that it's bad now. This is what the market can do. Now you're just buying it kind of at a discount. I've talked to many people that are like, well, I want to wait until, starting this account or adding until the market does better. And it's like, well, you want to wait until the price has gone up to buy? So I think that, a lot of times it's just really leaning on us and to say, what we're doing is helping you take the emotion out of it. It's like, hey, I don't want to put something in and then, hey, it goes down 2 or 3% in a couple of days. At the same point, it could go up next week. So, looking at that, the other thing that we've run into with, some potentially, younger than retirement clients is, hey, I just sold a house and I have some proceeds to a house. What do I do with this money? And do I want to add it all right now? And I'm going to let Elizabeth kind of talk about that example. But really it's getting in the market, getting your money out of banking and getting it into the market. So I'm going to be quiet and let Elizabeth talk about, where we're seeing opportunities with our people that are in the retirement red zone type area.
Sure. Yeah. So for that retirement red zone, for those lump sum clients, right, regardless of where you fall, I think a really great way to be able to participate in the market is to not try to time it. It's all about, like Jeff said, systematically adding. And sometimes it's a great opportunity for those lump sums too. If you had $100,000 right now, you said, I really would like this invested, but I'm nervous about where the market's at. Maybe you add a quarter of it now, and then you add a quarter of it maybe a month from now. And a month from now, one of two things are going to happen. Either the market went up or the market went down. If the market went up, then great, you made money on that first deposit. If the market went down, then great, you have another buying opportunity at a lower point. So it is about having kind of that long-term zoomed out, as we like to say, perspective. And then I think the last opportunity that we'd be remiss if we didn't talk about, because we've had a couple videos on Roth conversions, things like that. Typically, if you watch those videos, we recommend that those are done at year end, because you kind of know what you're working with in regards for income and what your tax bill would be on that Roth conversion. However, we always kind of put in a disclaimer that not always, and sometimes there's other opportunities to do those Roth conversions. And I think one of the biggest ones is potentially now, when we do have downside in the market. Because follow me on this, if let's say you were planning to do a $30,000 Roth conversion at some point this year, let's say that should make sense for you come December. And let's say the market, was flat or was up. You would do that 30 on that full 30. You pay the taxes on that when you did your conversion. And then hopefully the market, continues to have an upward trend long-term on that portfolio. And you would save in the taxes of that future growth because it would be in the Roth. Well, now we're in a spot where if you could do that $30,000, you're doing it with more shares, right? So going back to what Jeff said, right? That $30,000 represents more stuff, more shares of that investment. So now when you do that conversion, you pay the same amount of tax now, but you're doing it while the market's lower. So there's more potential for upside growth. And that upside potential growth is all going to be tax-free. So that's a big one as we're working with clients and kind of checking in with them during their mid-year reviews, is if Roth conversions are on the table for this year, without that crystal ball, we don't know if it's now or then. That'll be a better time. But we do know that now is definitely an opportunity, and it may make sense to take advantage of that before year end.
So if you have questions on this stuff, please, set an appointment through our Calendly link, subscribe to our channel, check out our other videos. If you do know people that you think, hey, I want you to hear about this stuff, feel free to share information. And as always,
Go Bills.